everyone, I'm Jane Hanlon, a Mortgage Club Manager for Advise Wise, and welcome to today's Ask Jane. Question today is from Craig at Sevenoaks. Why do some lenders base early redemption penalties on a variable basis and not fixed like most mortgages? Well, basically equity release is a lifetime mortgage and generally considered lifetime, so long term. Lenders charge for early repayments in different ways. Some charge a variable gilts and some charge fixed like most mortgages. Redemption penalties are designed to help the lender recover costs and put the lender back into a position it would have been in had the lifetime mortgage run its expected term, which is usually to death or long-term care. Variable gilts are based on UK government bond. The bonds are issued by the government to raise funds for public spending in the UK, known as gilts. Gilts have a good indication of long-term interest rates, which is why they're used. Aviva based theirs on a specific gilt based on the age and the time of your expected term. The rate shown is given when you receive the money and is shown on your completion letter. With other lenders, it's based on the 15-year gilts, and this will be shown on the offer letter. So it's really, really important that the advisor reads the KFI to see what the redemption period is. Most lenders go to an age of 90, some slightly less, but it's important to read the KFI. The downside to variable gilts is penalties can be up to 25% depending on the lender, should the gilts run the wrong way, which I'll explain in a minute. The upside is if the gilts, which are running at about 0.9 for 0.5% and has got lower and lower over the recent years. A few years ago, it was running at around 4%. So as you can see, everything's dropped in line with everything else in the current climate. These rates can be found on the FTSE and Financial Advisor market and also on www.marketwatch.com. They change daily. So if you are going to repay your lifetime mortgage from choice, not if you die or go into long-term care and all the other features which I'll mention in a minute, when the gilt is running lower than when you purchased it, so if you purchased it a few years ago at 4% and it's now running at 0.5%, then a redemption penalty will be payable because the lender will want to recoup the money and the shortfall to be able to re-lend that money back out again at a lower rate of interest. If the gilt is running higher, and there is a little margin, a bit like currency, over and above a certain amount, no penalty will be possibly payable. So again, you can pay up to 25% or you can pay 0%. There are very, very useful guides from the lenders on their websites, which are consumer facing. So from an advice point of view, you can leave the client with the appropriate lender's paperwork explaining how the gilts work and all the questions and answers that the client may have. With regarding fixed early repayment charges, most lenders will base this on the initial amount. So if you're borrowing 100,000, that could be a percentage of that 100,000, and they vary from 5% through to 8-10%. Other lenders will base the fixed on the balance, which means it's on the initial amount plus any rolled up interest. Or if in the event of you've been making capital payments against that, it will be against the initial amount less the capital payments to reduce the amount. This is then over a fixed period of time, depending on the lender, which could be 8, 10 or 15 years. Bearing in mind, this is a lifetime mortgage and is designed to be for lifetime. The downside to the fixed penalties is if you repay within that period, you are guaranteed to pay a redemption penalty. The upside is everyone knows exactly at any one time how much it will cost. Both variable gilts and fixed early redemption penalties have the positives and negatives. From an advice point of view, the advisor with the fact find should help him record the client's preferences, probing questions, recording lots and lots of soft facts of what's happening now and what the client wants in the future. Are they going to move? Are they going to inherit? Do they want to make payments? Just remember, all lenders offer the facility to port under the Equity Release Council rules if moving. That may be downsizing. Some come with downsizing options. Some have the option to repay on the ad hoc payment of 10 and 40%, and others have the, if a joint application becomes one, by unfortunately dying or one going into long-term care, most will offer a 3-year window in which you can repay that debt, which may be from a life policy, maybe because you move in with family, where there are no redemption penalties. So that's regardless of whether it's variable gilts or fixed, that the facility is available to you on certain products. So it's important to read the lender documentation on the features. From the advice, some will want the cheapest rate, with many of the gilt lenders offering the cheapest rates at present. Some will want the security to know what exactly the cost should they wish to repay, and these tend to be more expensive. So both have options, each client's different advice and recommendation. The important thing is you know your client. Both have their place and offer choice. We would welcome more of your questions. Please feel free to submit by going to advisewise.com. On the Upskill page, you'll see you can enter them in and press the button to submit, or please just give me a call. We thank you for your time. We hope you enjoy our AdviseWise platform.